Hello and welcome to A Tenner a Day, your weekly YouTube investment channel. Last week has not been the kindest for our portfolio. Would you like to know what happened with our portfolio? Stay around until the end to find out. If you would like to know what our channel is based upon, I would suggest you watch this video. For the current video, we are going to take a deep dive into REITs and our stock pick, Realty Income. Imagine, you're looking for a way to invest in real estate, but the idea of buying and managing property seems overwhelming. You don't want to deal with the hassle of property maintenance, tenant management, or the risk of a single investment. What if there was a way to invest in real estate without all the stress and complications? That's where real estate investment trusts, or REITs, come into play. REITs are essential companies that own, operate, or finance income-producing real estate. They pool capital from investors, allowing them to buy large-scale properties such as office buildings, apartment complexes, shopping malls, and even cell towers. By investing in a REIT, you get a slice of the real estate market without the need to deal with tenants or property maintenance yourself. What is the magic behind REITs and what makes them special? Let's break down some of the unique features that make REITs stand out in the investment world. Firstly, income-producing real estate. REITs focus on properties that generate consistent rental income. Think commercial buildings, apartment complexes, and retail spaces. By owning and leasing these properties, REITs provide investors with a steady stream of income, just like owning your own rental properties, but without the management headaches. Secondly, tax advantages. Here's where it gets interesting. REITs get special tax treatment. In order to qualify, they must distribute at least 90% of their taxable income to shareholders in the form of dividends. This, pass-through taxation, means that REITs don't pay corporate taxes, which can be a huge benefit for investors, as the dividends are taxed at a lower rate than traditional income. Thirdly, diversification. Instead of putting all your eggs in one basket, investing in a REIT means you're spreading your investment across a diverse portfolio of properties. Whether they're office buildings in New York, shopping malls in Texas, or apartments in California. This helps reduce the risk that comes with putting all your money into a single property. The fourth reason is liquidity. Unlike owning a physical property, which can take time to sell, many REITs are publicly traded on stock exchanges. This means you can buy and sell shares of REITs just like any other stock, offering a level of flexibility and liquidity that direct property ownership can't match. For the fifth reason, we have professional management. REITs are managed by experienced professionals who handle everything from property acquisition to leasing and maintenance. These managers know the ins and outs of the real estate market, ensuring that your investment is in capable hands. There are many types of REITs, but there's a certain way you can diversify them. The three phases of REITs, the different types you should know, are equity REITs. These are the most common. They directly own and manage income-producing properties. When you think of REITs, you probably imagine an equity REIT with its portfolio of office buildings, apartment complexes, and shopping malls. Secondly, there are also mortgage REITs. These REITs don't own physical properties, but instead invest in and originate mortgages on commercial properties. Their income comes from the interest on these loans, offering a different kind of exposure to real estate market. Hybrid REITs. As the name suggests, these combine the best of both worlds. Hybrid REITs own some property while also investing in mortgage loans, diversifying their income streams. Now let's talk about the many benefits of REITs. Investing in REITs comes with a host of advantages. Firstly, high dividend yields. REITs are known for offering attractive dividend yields. For income-focused investors, this is a major draw. The consistent cash flow from rental income is passed along to you in the form of dividends. Secondly, diversification. As we mentioned, by investing in a REIT, you're not just buying into one property. You're gaining exposure to a whole portfolio of properties in different sectors and locations, reducing your overall risks. Thirdly, liquidity. Publicly traded REITs can be bought and sold quickly, which is far easier than selling a property. Fourth reason, inflation hedge. Real estate tends to appreciate with inflation. making REITs a potential hedge against rising prices. When inflation drives up the cost of goods and services, real estate value often follows suit. And the last one we already talked about as well, professional management. With REITs, you have experts handling everything from property acquisition to tenant management. It's a set and forget it type of investment, with experienced professionals managing your portfolio of real estate assets. But you should not forget, every investment has its risks. Like any investment, REITs aren't without risk. There are a few key things to keep in mind before diving in. The first point we'll be talking about are interest rate risks. REITs are highly sensitive to interest rates. When interest rates rise, borrowing costs go up for REITs, which can hurt their profitability and impact property values. This is why REITs can sometimes struggle when the Federal Reserve raises rates. Secondly, economic cycles. REITs' performance is closely tied to the broader economy. In times of economic downturn, occupancy rates may fall and rental income may dry up. This is something to watch, especially during periods of economic instability. Thirdly, competition. The real estate market is competitive. REITs must constantly contend with other property owners, developers, and even new market trends that can impact rental income and property values. Fourthly, property-specific risks. Sometimes, individual properties in a REIT's portfolio might experience issues. Think tenant defaults, unexpected maintenance costs, or changes in local economic conditions. Or, for example, as we're seeing right now in California, natural disasters. The fifth part is management risks. A REIT's success hinges on its management team. Poor investment decisions, lackluster property management, or failure to adapt to market trends can hurt a REIT's performance. So, let's talk about how do you invest in REITs. If you're interested in REITs, there are a few ways you can get started. Of course, firstly, you can always buy direct stock purchases. You can buy a share of publicly traded REITs directly on the stock market. This gives you access to real estate assets without needing to buy a physical property. Would you like to know more about it? Let us know in the comments. Secondly, there are also REIT mutual funds and ETFs. If you want to spread your investment across several REITs, you can look into a REIT mutual funds and exchange-traded funds, ETFs. These funds pool money from multiple investors and invest in a variety of REITs, giving you exposure to different property sectors. Thirdly, there are REIT-focused funds. Some funds specifically target certain types of REITs, such as residential or commercial properties, allowing you to focus on specific sectors. Of course, it's all fun and games talking about the theory behind REITs, but what does it mean for our portfolio? We have decided to take a look at Realty Income, the REIT that we already have in our portfolio, and compare them to the three other REITs with the highest market cap, which are Prologis, Equinix, and the American Tower. But before we start the analysis, we're going to take a look into Realty Income. Realty Income, one of the most popular REITs, often called the monthly dividend company because of its consistent monthly dividend payouts. Even though the stock price of Realty Income has faced challenges in recent years due to the rising interest rate environment, its underlying business has remained strong. In fact, its adjusted funds from operations, FFO, were 19% higher in the first 3 quarters of 2024 compared to the 3 years ago, demonstrating that the company's core operations are solid despite stock price fluctuations. But why did the stock price drop? The main issue lies in the interest rate environment. When interest rates rise, the cost of borrowing increases for REITs like Realty Income, which can hurt their stock performance and put pressure on property values. That's a key consideration for anyone thinking of investing in REITs during periods of rising interest rates. So, let's talk about the verdict of our analysis. Which REIT is the strongest? After analyzing various REITs, we decided to compare the previous named REITs. Here's what we found. Profitability. Both Realty Income and Prologis stand out for their profitability. However, Prologis excels in profit margins. Revenue growth. Realty Income shows the highest year-over-year revenue growth, making it an appealing option for growth-focused investors. Valuation. Realty Income is priced reasonably with a lower EV to EBITDA ratio compared to some of the other larger REITs. Dividend yield. Realty Income offers the highest dividend yield, which is great for those seeking income. Stock performances. Equinix has the strongest stock price performance over the last year, but Prologis seems to be the most well-rounded overall. After a thorough analysis, we concluded that Prologis Incorporated stands out as the strongest REIT, offering solid profitability, strong free cash flow, and a reasonable valuation, while REIT income remains a solid choice for income investors. Prologis provides a more balanced approach with a strong growth potential and stability. Concluding this analysis, we have decided to sell our position in Realty Income over the weekend and buy back Prologis, since we think this stock comes out as the strongest REIT from our analysis. Do you have any suggestion for a potential stock we can investigate? Please let us know in the comments. Now we're going to talk about the last week development of our portfolio. This week has not been the nicest for our portfolio. We have seen drops throughout the whole week. However, we are not scared of these drops. Since we're buying every day, we will see some gains, we will see some losses. We are in it for the long term. Hopefully you will join us for the long term as well, so press that subscribe button. As of right now, as you can see, we have invested 120 euros. We have made a total return of minus 2.27 euros, making it a total return of minus 5.9%. Thanks for watching, and don't forget to like, comment and subscribe.